Hi, I'm Ali Patterson and welcome to the Insurtech Show. In the last 5 years, insurers have had to address a myriad of rules and regulations, not least Solvency II and IFRS 17. And these have resulted in a lot of sticky plaster fixes to barely meet compliance. Together, there's been a fair few mergers and acquisitions within the industry, and it is now facing a very expensive mess of spaghetti systems that are no longer fit for business purpose. Where do insurers start to look when it comes to transforming, and what outcomes should they be actively looking to achieve? To find out, we have brought in a number of experts in the field to see what insurers can do in such a predicament. Joining us today, we have Aptitude Software's Jeremy Marchant, a company who are 100% dedicated to the finance office and are leading the way in digital transformation and modernization of this now critical role in banking, the CFO. Carl Moxley, the CFO at Legal & General, a financial institution established in 1836 and is one of the UK's leading financial services groups, and with a major global investor with international businesses in the US, Europe, Middle East and Asia. And last but not least, we speak with John Keppel from Zurich, the leading multi-line insurer that serves both global and local markets. Do you think that the insurance industry has applied, sticky plaster fixes to systems to ensure compliance? And if so, what impact has this had on insurers' finance departments?
Well, I think the answer is definitely yes, right? Most insurers, as you know, unsurprisingly, most industries tend to do sticky plaster fixes to regulatory requirements. The leadership teams always have that delicate balancing act between becoming compliant and doing it effectively in an efficient way. So I think yes, the insurance industry is no different. You know, whether you look at the GIs or life or composites, you know, Solvency II was the first big transformation over 10 years ago now. IFRS 17 has come along, and as a wraparound, increased regulatory oversight on those things, and often sticky plaster fixes have been put in place, and that's fair enough for a number of reasons. You know, people don't want to spend too much. They want to wait until the requirements are fully finalized. In particular, people wanted to wait until they could see what IFRS 17 looked like and the overlap or alignment with Solvency II. So there are good reasons sometimes to do sticky plaster fixes. But you're right that has led to big impacts, negative impacts on the finance functions. They're costly, right? So where you've got fragmented architecture, you've got lots of expensive people and processes to paper over the cracks. You've got lack of agility. You know, when the CEO or the COO comes to CFO and said, well, we're thinking of doing an acquisition. What would it mean to our business if we bought XYZ or this book of business? And well, often the CFO says, well, come back in a month. I can't really tell you now. So lack of agility and reacting to the market is a problem. And I think thirdly is the transparency. You know, the finance team is spending so much time holding the sticky plaster down and making sure it's still sticky and making it work, that you've got people who could be giving a lot of valuable insights to the CFO and the rest of the C-suite and the organization, and they can't because they're spending so much time on reconciliations, on analytics, proving the numbers are right, fixing the numbers, and they can't sort of step out of that mindset, no matter whether they have the skill set or not, to give those insights to the business. So, you know, that does mean that things like suboptimal pricing, new products take longer to come to market. So overall, it comes back to an organization that is less reactive, less adaptable to the market and the competition it faces, and less competitive because they've got a high cost to income ratio. So, you know, all those things are enterprise-wide significance. You know, this isn't just an issue that impacts the finance team on its own.
What have been some of the biggest changes in terms of regulation in insurance?
I guess the obvious one, which was implemented in 2016, was Solvency II, and that was a kind of more complex and deep capital regime, and that clearly was a fundamental shift, I think, in Europe and how insurance companies had to manage their reporting and their capital calculations. So that was a big one in the past. There's a few large ones coming up. I think your listeners may have listened to something recently on IFRS 17. That'll be implemented in 2023. So again, that is another change in the amount of information and detail and data that's required in terms of our accounting on an IFRS basis. And then it's probably not, I would say, a regulatory change, but a kind of increasing focus on operational resilience as well. So in the past, in particular, banking and insurance industries have had a lot of focus on their balance sheet resilience, so capital and liquidity in particular. That's now moving more to the operational side. So whilst we're still obviously doing a lot on the capital and liquidity side, more and more focus is being put on operational resilience, and in particular, given all the changes in digital kind of outsourcing vendors and so on and so forth, and cyber risks, the kind of operational landscape is something that's really, really important to the insurance industry and our company in particular. And that is also influencing the way we think about the risks, in particular when we start to think about digitalization.
Is the insurance industry guilty of in the past applying stopgap fixes to old systems to achieve compliance? And if so, what's some of the motivation behind this?
Yes, and it's probably nothing to do with the recent changes. I mean, I think insurance, it's a very old industry. It's an industry that's been around through various iterations. There are certain barriers to entry at scale in the insurance industry. And it means that we sometimes make decisions on business cycles. You know, I don't think we're alone in that. You know, somewhat more short-term business cycle thinking than strategic. There's plenty of examples of organizations trying to make strategic, decisions and leaps, and sometimes they work, and sometimes they're catastrophic failures. So, I think it's fair to say the insurance industry has maybe missed a few boats in terms of its pace of adoption and stopgap type solutions.
What do you see as the main drivers for change in the finance and actuarial departments of insurers? Which ones are more important than the others?
Yeah, so we, from our own research, we actually identified 10 drivers for change. We've looked across the big four, the SIs, all the clients that we are doing transformation for, and identified 10 real drivers for change. But as you say, some of these are more important than others. So I think the key top 5 that we would highlight, number 1 would be the antiquated legacy systems that they're all sitting on. These are often 20, 30-year-old systems, and these are just inhibiting the change that insurers need to go through. I think secondly is the high costs that means for the organization. You cannot just simply carry on running on your legacy platforms with the cost base that it delivers and means for the organization. You just won't be competitive anymore. I think number 3 is the proven value of digital disruption, right? I mean, it's all very well having a problem, but unless new technologies work and do what they say on the tin and deliver the value that they say they will, then the drivers can kind of be meaningless. So what we've seen is that the digital disruption has been proven, has worked, has delivered value, and clearly the C-suite and CFOs are therefore looking at change much more positively and much more flexibly. I think number 4 would be the increased regulatory burden. If you look back the last 15 years, Solvency II didn't exist, IFRS 17 didn't exist. The regulators were less stringent in terms of what they looked at from insurers. Even things like in COVID, we're seeing the big insurers having weekly meetings with the regulators to review their capital. All this burden has been a driver for change, because it means you've got much more complexity, much more data, and much more focus from the C-suite in terms of how they meet those regulations. 20 years ago, the C-suite probably didn't care about a lot of the data that now needs to be reported. Well, now it does need to be. So that's clearly a driver for change at the senior levels. I think the final driver for change is the market competitiveness, right? I mean, the industry is much more competitive. It's no longer what used to be perceived, 10, 20, 30 years ago as a sort of backwater of the financial services industry. There is huge competition in the industry. There are organizations who are acquirers of either companies or books of business who can generate more profit from that than the legacy organization. And what that means is price pressure and C-suite pressure. So as soon as the C-suite has pressure from the shareholders or from the market, well, surprise, surprise, that means pressure on the leaders beneath them to make things better. So, to go back to what I said at the outset, there are a large number of drivers for change, but hopefully those top fives give you a good view of what we see as the key ones as to why people start looking at transformation as a thing that needs to happen.
For insurers, is finance transformation all about achieving compliance in a more efficient and cost-effective way? What other key drivers are there for change?
Yeah, I think you're going in the right direction with that. I think it's getting approval for transformation and talking about the benefits can be a very dry topic. You start talking about things like cost reduction, how many processes can be decommissioned, how many FTE will be impacted, how many systems can be decommissioned, and it can become, clearly that's important, right? You need to have that robustness often to be able to get funding approval. You need to have a robust business case, but it's not a particularly inspiring way to talk about transformation. And what we find works to, I guess, help the leadership step out of their mindset is to use an approach that we call I would like. So instead of saying, oh, you can reduce your manual journals by, say, 50%, you have a technique where you say, well, I would like to decommission all of my claims systems that my team has been complaining about for 10 years. Or I'd like to be able to analyze our financials without having to go into our clunky GL and without having to implement another GL. Another example would be, I'd like my incredibly highly qualified and expensive team to spend their time in helping me with analysis rather than doing some complex manual processes. So, we find it's a bit more inspirational to talk about the vision in that sense. What would you like to do that you can't do now? And that's what gets people inspired about the change journey. Yes, you need those metrics and the really robust business case, but that's not going to take people on the journey, and it's not really going to get the leadership team interested in the change. It's those things that you want to be able to do but can't do now that will get them excited.
As the finance function, how do you also add insight and value to the business? It's not just about reporting what's happened in the past, where for me the real value is predicting and looking at the future. And a lot of this transformation journey will give the space and time for my finance function to be able to do that. Whereas historically that's been more of a challenge. Clearly they've done that as well, but spending so long working processes to get the calculations and output they need to help with those decisions. If you can make that faster and more efficient, everything after that is value add.
The issue for finance departments is kind of how core they are to insurers. And therefore, as we talked about before, they're involved in everything. The resource is quite scarce. It doesn't matter whether you're doing acquisition work, divestiture work, period close, annual close, statutory accounts. I mean, every single part of a finance function's role is pretty much deemed critical to someone, and they're a very, very important control function element in an insurer. So they're not something that insurers are going to mess with lightly. So engaging in substantial programs of change in finance is something that most CFOs and frankly most COOs aspire to achieve, but do so with a degree of caution and prudence. So I think that sometimes limits ambition. And I would certainly say that, you see evidence of that around the place. And sometimes it's why other functions transform more rapidly. And and what happens sometimes in finance is, actually let's just apply some more people to that problem, because it's got particularly painful, or we've got a lot of activity coming through. I think we've also had a couple of big ticket items, which certainly for insurers have been material in most cases. Brexit has put yet another burden on most finance functions. They're heavily involved in those sorts of preparations, etc. So there's a few reasons that I would say both absent the personal situations or the current situations, that mean that finance can sometimes be a little bit slow to embrace change. But I think that's changing, and I think unlocking data and unlocking that data science element will really help finance organizations free up capacity and then use that capacity to help them modernize.
It can be scary, right? As soon as you say the word transformation, particularly in insurance, when a lot of insurers haven't done transformation. And sometimes when we talk to our clients, we know not to even use the word transformation because it implies big money and big budgets. So it is an elephant in the room that needs to be slayed in that sense. So how we look at this is clearly there is a vision, right? You need to have a vision, otherwise, what is the point? If you try and be so tactical that it's just not an exciting thing to suggest, then you're not going to get people to buy into the journey. But on the other hand, that vision needs to be achievable and needs to be demonstrate value, and the value that you said it would needs to be delivered pretty quickly. One thing that I've learned from leading sort of multi-year transformation programs is that if you stop delivering or lose momentum, the money starts to go away, right? People start eating away at your budget. People start sort of poking at your projects, saying, "Oh, are they really delivering value? Oh, it's delayed. Or maybe we can use the money better elsewhere." So you really do need to keep that momentum going, and that does mean coming up with quick ROI and short delivery projects initially, but making sure that once you've built that momentum, that you've got stuff on your back book that can come in and continue to maintain that momentum. It's all very well doing something in 3 or 6 months, but then what comes after that, and how does that fit into your overall vision? So just some ideas as to what those tactical things can be. What we find works quite well in terms of bang for buck is automating some of the manual allocation routines or repeatable processes in finance. Now you've got things like capital allocations or apportionment of costs across business units or contracts in the business. And these are things that are just done manually in Excel often, or at best in an Access database. Automate something like that within, say, 2 or 3 months, have an ROI that pays back over 4 or 5 months, and then you're off the blocks, right? Then you're starting to build the momentum. You've proven that what you said would work has worked, and then you can start dripping in things that have a longer ROI. So you can start those longer term projects at the same time, so that when you started to build that momentum, those projects are starting to drip in benefits as well. So there are ways of delivering ROI in 6 months and certainly under 12 months. You've just got to find them and get the people on side to deliver them. But yes, I agree with you. That is a critical part of starting on the journey in a way that isn't scary, but does start to deliver things quickly.
This is a great opportunity for insurers to really think about their future finance processes. And where I guess certainly I'm looking, I've mentioned cloud in the previous question. That is another area where actually it just does make things faster. It does make things more controlled. And I think that automation and using new tools, and there's lots out there, I won't mention specific names, but new ways of coding and new ways of data mining, and I haven't talked, but I'm sure artificial intelligence and machine learning is another area that can be utilised in this type of sphere. That all of these things, in my mind, certainly enable you to future-proof, certainly in the medium term. That said, I think we do need to be cognizant of the extra risks that brings. So when you're starting to move things off of the mainframe onto the cloud or external providers and so on, where the future proofing will occur is if you have control of that. But to a certain extent, by moving to these different types of technology, in some cases you're introducing different risks. You're introducing cyber type risks, you're introducing different IT mainframe risks, especially if you're reliant on someone else's recovery plan and not your own. If you start to move into artificial intelligence or start to move into machine learning, you need to be cognizant that who's programming that, and are they programming it with their own bias, which then you don't inadvertently see in the results. And I guess also when we think about the layers of governance and control within insurance companies and wider, we obviously have a second line. And have the second line got the sufficient skills to be able to be comfortable with the risks that may evolve, and we the insurance companies are taking these types of technologies, and all of these things are quite live and important discussions to have.
Well, that's all we've got time for on today's episode of the Insurtech Show. I hope you've enjoyed hearing about where insurers are on their digital transformation journeys, especially in their finance departments. It seems that the industry as a whole is starting to put a real focus on their finance departments and the digital transformation that is happening there. Big thank you to all of our guests today, and to, of course, you at home. Join us next time for the next episode of the Insurtech Show. Goodbye.